A very warm welcome to everybody today to the launch of our new report, Development Finance Institutions, the Need for Bold Action to Invest Better. My name's Sam Attridge and I'm a Senior Research Fellow here at ODI, and my work focuses on development finance institutions, national development banks, and the use of public money to mobilise private money for investment in the SDGs. So I'm going to make some very quick remarks just to set the scene about the report, and then I'm going to quickly introduce the panel, and then we're going to get this conversation going. So the report that we're launching today examines the investment portfolio of 12 development finance institutions and multilateral development banks, and that's the private sector operations of these banks. And we look over the period from 2013 to 2018, so it's pre-COVID, and these institutions accounted for about 70% of the private finance that's been reported to the OECD, so quite a representative sample of the wider universe. So in a nutshell, we find that these institutions are at a critical juncture, an inflection point. And we found think that the increasing emphasis by the international community on mobilising private investment has now been accompanied since 2015 by increased expectations on what these institutions should be doing. But we find that their business models have been slow to adapt. So in summary, very briefly, we find some good news, some green shoots emerging. We see an actual reallocation in the portfolios of these institutions towards lower middle income countries and low income countries. So investment away from upper middle income countries, suggesting a shift in their risk appetite, increased leverage, and also that their investment is growing. However, if we think about the challenge that we face, we find or observe that progress collectively has been slow. So DFI and MDB investment has been actually growing quite slowly at an annualized rate of about 1.6%. And we haven't really cracked this kind of mobilization at scale issue, especially from institutional investors. And we also find a dominance of debt in the product mix. And we've seen that actually this has increased over the period that we looked at. So enough about the report, and we'll post the link later in the chat room online, and it can be found on our website. So we've got an incredible panel today of industry leaders. I'm really excited to have this opportunity to reflect with the panel on this inflection point and explore what kind of bold action we need. So joining me today, and in no particular order of importance, are Catherine Steger, Head of Public Sector Coverage in Europe at Standard Chartered Bank, Joyce Zudberg, who's the CEO of Cardano Development, Andrew Herskovitz, Chief Development Officer of the US International Development Finance Corporation, and Jean-Philippe de Cheval, founder and managing partner of Bamboo Capital Partners. So we have a great large online audience today with over 320 participants registered, and we're really going to encourage our audience to ask questions and participate in our conversation. And you can do this by entering your questions in the box below this video or on the audio stream. Additionally, please use the hashtag #ActionToInvestBetter to tweet your questions and comments about this event, and you can find us at ODI_global. So let's get this conversation going. So Andrew, I'm going to start with you. So I mentioned briefly, that there's these new expectations about what DFIs are expected to do. And by that, I mean that I think they've been increasingly tasked to move beyond a narrow focus on job creation to focus more on making transformative investment to create markets and or mobilise private investment at scale, especially from institutional investors. But at the same time, they're also expected to remain financially viable and or profitable. So how have the US DFC's objectives changed, and what tensions are there between these, and how do you juggle these?
So the U.S. International Development Finance Corporation, its objectives haven't really changed because it's a new organization. We've existed for just over a year. And this is part of the mentality we have to get people to understand not USAID's Development Credit Authority anymore. So what we are is we're a completely new organization that our Congress created. But part of the issue is that all the staff from those two other organizations brought together to create this new organization. So there's still this mentality shifts. And so there are a couple of key changes that happened with the establishment of DFC. One, we were given equity authority, so that's what everybody talks about the most. But I don't think that's the most significant difference. And I'll get to what I think the most significant difference is. Two, we no longer have to have a US nexus with our lending. So we can provide lending or financing instruments to local companies, even if there's no US involvement in that. And that's such a great opportunity for us, one, from a development standpoint, but also from the opportunity of creating potential linkages and trade opportunities as we get involved with local companies and we learn of subcontracting opportunities or trade leads or investment leads for US companies. So it helps us become more integrated into the system. Another one of the key changes, though, that people don't really talk about is the way that we are funded from the US Congress is we get an appropriation and we don't have a shareholder. Our shareholder is the US taxpayer, but there's no legal requirement that we earn a return for the US taxpayer. What that does is it allows us to really play in the development space in a way where I've seen DFIs and multilaterals drift increasingly closer and closer to the commercial space. And this is why when Congress created DFC, they gave us this mandate to prioritize investments in low-income and lower middle-income countries, because private capital will go into upper middle-income countries, and we still have the authority to do that. But ultimately, where we should be prioritizing our efforts are in these low-income and lower middle-income countries, ones that tend to get left behind. So we have tremendous space now to play the role of what a DFI really should be doing, and playing somewhere in between a development institution and a commercial bank, as opposed to really close to a commercial bank. The other thing that I've been pushing, as the first chief development officer, is getting people to understand that I don't really care how much money we move. Like, I don't think it's wonderful if we move $60 billion. I care more about the quality of the transaction. Just because you invest $1 billion doesn't mean that you're having a development outcome. I want to know what the metric is that we're using to measure that development outcome. As a taxpayer, if I want to make money, I'm not going to invest it in a government institution. So the whole idea that a huge ceiling is great, it can be great, but that ceiling, those investments have to be made with a clear outcome in mind. Is it getting people access to potable water, getting people access to internet, getting people access to electricity? It's not just about the deal, it's about the outcome. And this is where DFC is increasingly focusing more and more.
Okay, thank you, Andrew. And I think perhaps some of the other panelists may touch more on this kind of the transformative impact, maybe rather than the kind of the numbers, the scale kind of numbers. So maybe turning to you, Catherine, from Standard Charter's perspective, I guess just also to do a little bit of scene setting for this conversation. The recent MDB and DFI mobilisation report for 2019, which was released in January, showed that the amount of private finance mobilised had declined. But also, if you look at the World Bank's public-private participation infrastructure investment, we see a huge drop-off in the first half of 2020, about 56%. So it looks to me that the job of DFIs has just got a whole lot more difficult. So I'm wondering, reflecting, what do you think are briefly the kind of short-term, medium-term prospects for this agenda are? And then kind of in light of that, what kind of innovations do you think are needed from DFIs to kind of mobilise private investment?
No, thanks. I think you're absolutely right. There has been a slowdown in the private infrastructure investment in general. If I should take infrastructure itself as an investment group, in 2019, Standard Chartered made a commitment to help with financing of 40 billion of infrastructure financing by 2024, and we are behind schedule on that. Just because the underlying activity is not there and not happening. But we are beginning to see things tick upwards again. And actually, if anything, that underlines the importance in uncertain economic times of the DFI and the multilateral community, frankly, more than it ever has been needed. I think you're absolutely right. There is a trade-off between, or very often a trade-off between innovation and between scale. The dream is to have innovative structures, innovative solutions that can be scaled up and that help crowd in more and more private capital. The reality is, very often to innovate, there is, and Andrew made a great point, it is about looking at the impact sometimes rather than necessarily the returns, and getting the right balance and seeing even more of the DFI community willing to take the risks or look at the pricing that is needed to do something different and do something innovative. And I think having the right partnership between the commercial sector and the DFIs to help identify the additionality and the impact of structures is absolutely key. I think there's a lot more all of us can do in the distribution space. So not just looking at how we crowd in at inception in the private capital, but once we've got things up and running, essentially the exit route for DFIs and for MDBs. And I think there's some good work that's being done in that space, but that's something that as the underlying activity begins to scale up, we can do more. I think it's really refreshing that the institutional investor community is more and more interested in how they can be supporting sustainable and developmental projects and impacts. And I think how we think about their measurement and ability to tap into that on a much more programmatic and scaled up basis is going to be really key. And I think there's something incumbent on the DFI community and those of us in the private sector working in partnership with them to be thinking about that from the very early stages, rather than that being a last stage that we try to shoehorn things together and try to solve it at the very end of a process. So for example, actually I look at some of the work we've done, for example, with CDC in the trade finance distribution space, actually building that up to a more programmatic approach. It's slow to get there initially, and once you do that, things move a lot more efficiently. I think the work that's been done on collaboration, rather than perhaps, if I dare say it, some of the DFIs working in a little more of a competitive space, has been really great to see over the last few years. And I think that's going to have much more impact again on having more structures that are replicable, can be taken into different places. But I think we're going to come and talk about the lower income markets a little bit more later on. We have to be aware of regulatory constraints, capital constraints, and if we want to be doing more in the local currency space, which is hugely important, that does make things harder to scale up and put together funds affecting multiple markets. And I think we need to recognise those trade-offs, and as Andrew said, think about the impact that's being made.
Okay, thank you very much. Joist. So as I said, I think our report finds that there are these expectations, especially around, and I think picking up on this point around impact, so more impactful investment. So, but we don't find that the business models have kind of changed. So your organisation, Cardano Development, is a well-known kind of innovator and incubator, as well as a fund manager. What do you think kind of constrains DFI innovation to invest, if you like, for this transformative impact to kind of really create markets in some of these challenging markets?
Yes, Sam, thanks. I wanted to say that my comments are going to be in the light of, I'm a big fan of DFIs. I used to work at one, and all of what we do is supported by capital from DFIs. At the same time, I'm looking at it critically in the sense that what the DFIs have been extremely good at in the last decades is also becoming one of the reasons why perhaps in mobilizing other people's money, they are less effective. And what I mean by that is that if you see what have the DFIs developed as a very core strength is deployment of their capital to do good and well risk managed transactions. At one hand, at the second hand, to become very efficient organizations, to say it bluntly, to spend the least amount of hours for the dollar put to work. And if you look at, in contrast, the work needed and the results made in mobilizing other people's capital, does not play into either of those two strengths. The activity does not lead to, in particular, assets deployed, and it's harder work per effect. So if you look at the impact to be had with mobilizing capital, there is no doubt everyone understands that this is a good thing. However, the metrics and the targets of those KPIs associated with that are to some degree crowded out by perhaps more urgent KPIs to achieve deployment of assets into the real economy. Thanks.
Okay, thank you. Thank you. We can perhaps now turn to Jean-Philippe for your reflections as an impact investor. I'm sure you'll pick up on some of these issues that have been raised around, what do you do and why do you do that?
Well, thank you, Sam. Briefly, Bamboo first is an impact investor. We've been around the last 14 years, and I think we've deployed over $500 million in small loans and small investments in SMEs, in emerging and frontier markets, focusing essentially on what is called the missing middle, meaning those companies that need small amounts of money, as low as $250,000 all the way to $5 million. And the companies we invest in, provide basic services to low-income population, access to financial services, healthcare, energy, education, and they do so increasingly using technology as a way to improve the affordability and the accessibility of the services they sell and they provide. And I must say that it's really a tough segment to invest in. It's also very costly to invest in. And I will tell you, transparency, that it's a segment where asset managers are not in the business of making money. Otherwise, they would leave the segment very, very quickly, and they would migrate to the $20 to $50 million average size tickets. We stay true to our mission, which is the $1 million average type ticket. Now, recently, in order to improve our work and to grow it faster, frankly, we have teamed up and we have structured innovative partnership with UN agencies and international NGOs, such as the United Nations Capital Development Fund, the International Trade Center, the International Fund for Agricultural Development, the Stop TB Partnership, Smart Africa, CARE USA, etc. And the idea is, of course, that those partners bring their massive presence on the ground, their deal sourcing abilities, technical assistance, impact assessment capabilities, and we provide, the financial discipline, the portfolio management, the investment process experience, and we feel that it's a real win-win partnership and complementarity of work on the ground. Now, in the context of those partnerships, we have structured what is called blended finance vehicles, and we are now, trying to put them together so that we can basically kill two birds with one stone. One is to be sizable enough so that we could attract the private sector, institutional private sector, to those funds, and yet remain true to the mission of staying in the missing middle and not, having mission drift and drifting apart to the bigger size of the market, where it's more profitable and easier to place money. And Sam, I have accepted your invitation to this panel today because we have the capacity, we have the chance of raising several hundreds of millions of dollars for that segment, provided we find a few tens of millions of dollars of catalytic money from the public sector and DFIs. And guess what? We don't find it. So, at the time where we all talk about public-private partnership, blended finance, de-risking and catalyzing the private sector, I'm still, I'm puzzled and I'm wondering what's going on. And but responding to your question of what we do, we operate in the trenches. And the perspective I'm getting, I'm sorry, is only with small numbers and from the trenches, but where I hope you will recognize that where true impact and verifiable impact is being generated. So I'll stop here, Sam. Thank you.
Thank you. And perhaps I'll put you on alert that maybe later in the conversation, I mean, you raised a really important issue around ticket size of investment, particularly in kind of some of the more challenging of markets. So how can DFIs, kind of help you kind of reach or fulfill that middle gap? I think it's really important. But also, I think you're raising this issue around where the additionality is in terms of, I guess, in these higher risk capital. And our report found, as I say, a kind of a high use of debt finance, and we suspect, we can't confirm because of data, but a lot of that is in the form of senior debt. So there is this need for kind of high risk capital. So maybe we can reflect a bit more on that later in the discussion. So
Sam, I apologize. You're muted. We can't hear you.
Oh. You would think after a year of this I would have cracked that, so my apologies, everybody. So let's turn, Andrew, to you. As I say, mobilisation's been increasing. Actually, we've been seeing it that being driven by MDB, certainly up to 2019, where we've seen this fall off. But we're not really mobilising at scale yet. And I mean, I know you mentioned around impact being the kind of like imperative, but there is this vision, and you hear all the time about, tapping institutional investors to kind of really shift capital at the scale we need. And in our report, we say this needs kind of portfolio aggregated approaches which diversify risk. What challenges do you see as USDFC with this kind of scale agenda, and what kind of approaches do you do, to kind of really attract that institutional investment?
So mobilizing at scale, it's not necessarily, it's an opportunity. And I think we've learned a lot over the last few years. When I think back to when I was living in Africa, working on Power Africa, for example, we were supporting a program that brought US institutional investors, pension funds, to Africa to look for opportunities to invest and to partner with other African companies. And successfully, there was one investment from a US pension fund in Kengen, for example. But what we came to realize is that the real capital that we need to mobilize is the local pension funds and the local sovereign wealth funds. And here's why. There's no better risk-sharing partner than a local pension fund or a local sovereign wealth fund. If you're an outside investor coming in, you can have a choice between having your local partner be some guy who is the cousin of a minister and hope that everything's going to go well. But what I've seen happen time and time again is it does not go well. Or you can have as your partner a local pension fund. And no head of state wants to see a project that local pension fund is invested in go belly up. So that is the best risk-sharing partner that you can ask for. In addition, if you can structure deals in a way where the local pension fund is willing to take a senior tranche, but maybe cap its upside, that will help some of the institutional investors from overseas who are looking for double-digit IRRs come in and possibly mobilize that capital. But the challenge that you face with certain institutional investors, particularly from the United States, is when a country like Ghana issues a bond with a coupon rate of 8%, nobody wants to take the risk on an infrastructure project where the IRR is going to be 9%. So you have to create incentives for these institutional investors to come in. So that's one point about mobilization. The other point that I'll make about large-scale mobilization is that it goes back to my earlier point about DFIs being willing to take more risk and incur some losses. And I think that DFC is uniquely positioned to do this. I think back to the solar investments in Chile a decade ago, where a lot of the DFIs and MFIs actually lost a lot of money on those investments, but those were large-scale solar doing competitive tenders. But by being involved in those projects, they helped shape the market that allowed for future auctions in Mexico, in UAE, and all over the world, where you saw solar prices come down from probably over 30 cents per kilowatt hour to sometimes 3 cents a kilowatt hour. And it's because the role of the public sector institutions in being the first movers and helping shape those markets. And that's how you get to scale. So we have to take way more risk on the front end. Right now, DFC just entered into a partnership with the Rockefeller Foundation to try to mobilize investment in the distributed renewable energy space, mini grids, microgrids, things that everybody loves to talk about and saying it's the leapfrog and how power is going to work in the future. The truth is, it's just not commercially viable yet. But we're going into this looking in the next 5 to 10 years to see if we can help shape that market and get it to scale so that 10 years from now, there's not a need for us to be investing there. So we have to be willing to invest on the front end, take our losses, but help shape the future market so commercial banks can step in the future.
Andrew, just quickly, on that, DFIs aren't homogeneous, they're heterogeneous. So you said you're funded by appropriation. Actually, you don't have to necessarily make a profit. Some DFIs, rely on issuance on the capital market. So I guess the degree to which DFIs can take this risk varies. But I guess it'd be quite interesting just to hear your view on can DFIs, there's a few, especially on the bilateral side, which don't necessarily fund themselves in the capital markets, but this need for high risk investment does have an issue or potential, there's risk to profitability. So how can we get more of this high risk kind of investment capital from DFIs? What needs to change from DFI business models?
I think the governments need to look at the fundamental organizational structure of what their DFIs and remember why they created them in the first place and look at what they've gravitated towards. So if you think about it, if you're working on a deal team at a DFI or an MFI and you're getting a pat on the back for every deal that earns a lot of money and the size of the deal, you're never going to gravitate towards that small project in Guinea. You're always going to be looking for that large scale project with the higher IRR. So there's a cultural problem with what's been created. Similarly, we've heard people for years saying that DFIs and IFIs, once they help, shape the market with that early investment and take on that early risk, they should be selling off their portfolio. But they're not going to do it because the way that they're structured means that they need to have that income. So I love what the US government has done. And I honestly don't know that a ton of thought went into this, but I've discovered that for me, this is the most significant difference between OPIC and DFC in that we get an appropriation from our Congress year after year, and that's the way that it's structured. And we can pay the money back. We can earn money back or we don't have to, but Congress created DFC for the purpose of advancing development and foreign policy. And if we earn a return to the US taxpayer, that's great, but it's not required.
Okay, thank you, Andrew. Catherine, so as I say, and I mentioned in our remarks that we've seen a kind of a reallocation overall, if you like, away from upper middle income countries towards more investment in lower middle income countries and low income countries. But still, still a huge challenge to invest in these countries, and they receive quite a small share, if you like, of DFI investment. What do you think are kind of the main constraints to this agenda in these kind of markets? And is there something you think that DFIs should do more of or differently, to try and really create markets in these kind of environments?
I should probably start by saying I'm slightly biased here because Standard Chartered, we are operating in and on the ground in quite a number of low-income markets. So that's actually where we are partnering with many DFIs. So perhaps I'm the wrong person to answer the question, but I think there's a lot of good work, but I think it's recognition of some of the constraints and a willingness to be flexible and look at markets differently. It should just be fairly obvious, but that there are often interest rate caps that you need to deal with. So if you're looking at on lending structures, the regulatory approvals that might be required to meet the commercial bank as an intermediary or the DFI's requirements, perhaps touches on Andrew's point of requirements on returns, that recognition that may be a barrier. You can put in place an on-lending structure as we did in Zimbabwe with the DFI a few years ago. There are regulatory changes and the entire model just doesn't work anymore when the currency changes. Sometimes you've got to roll with those changes, realize they're there and look at alternative ways to work with that. I think there is a lot, we've touched a little on local currency and the need to try to look at how funding can be done more in that, be it through the use of TCX, through the use of counterparty swaps, be it through more direct lending and looking at the adjustment in returns. And I'm sure Juice will talk a little more about that in a while. I think there's also a role for the non-DFIs, for the ministries and others to look at policy engagement, whether it is those interest rate caps, whether it is the ability of municipalities to directly borrow versus things going through the state. There's also a question, and this obviously varies by who the organisation is on mandate. Actually, a lot of low-income markets, the role of state-owned enterprises or very heavily state-owned or administered organisations can actually be absolutely vast in the financial institution space for on-lending, be it to SMEs, to microfinance institutions, to corporates that have a real economy impact. As well as, for example, national development banks, and having a remit that permits some funding and engagement with that space rather than purely private sector can have quite a transformational impact, but that requires the mandate to be able to do that. So I think that those are just some of the things that I think are worth bearing in mind and thinking through how that mandate or return policy can allow for a bit more innovation and taking a different approach to normal in selected markets to have that initial impact.
Okay, thank you. Jean-Philippe, turning to you and putting our hats on to think about the future. I guess, kind of our report is saying that, business models need to change. How do you think DFIs can invest better to kind of mobilise investment in these markets?
Well, that's a difficult question to answer, and I'm maybe not the one person to answer that. What I can give is my perspective, again, from the trenches and from the missing middle in those emerging and frontier markets, and just sharing the difficulties we are facing and how we're seeing reactions from DFIs that are not very conducive to solving problems sometimes. And again, we work with DFIs, we have great relationship with DFIs, so I don't want to throw the baby with the bathwater, of course, and it's difficult to speak in general terms about DFIs because they all are very different, as you know. This being said, frankly, in general terms, and mostly across the board, we find DFIs having a high level of risk aversion. They are not, as you said, Andrew, they are probably not structured to take or incentivized to take risks, or the mission is not clear enough, or if the mission is clear, then it doesn't go into that direction. For example, on the so-called blended finance structures, no DFI whatsoever would take a first loss tranche investment, would take a catalytic, a tranche investment. None. We've talked to many of them. None to date. Then it's difficult, of course, if you don't go through guarantees to de-risk the private sector, if you're not going to take that risk, right? And be the catalytic capital. Some DFIs would even not invest in funds, they would just lend to funds and of course be the first on the waterfall at the end of the life of the fund, taking recourse on assets. And that's not very brave, right? It can provide cheap financing to the fund, but by leveraging it, not by investing in it and taking the senior risk position when actually first loss is what we really need to catalyze private sector. So in a nutshell there, it seems that when we talk sometimes to DFIs, we might as well talk to senior institutional private investors right away because they behave the same way, right? The second thing I would say is, and that's of course probably linked to the first point, is that when you come in general terms again to a DFI with a new ID, a new structure, a new financial tool, a new model, a new partnership, there's no incentive to embrace innovation, at least not across the board and not systematic. I mean, again, we've come with this, to take an example, with this structure where we aggregate different, blended finance impact funds with different partners, and 2 or 3 DFIs that we approached told us, look, this is exciting, this is really good, but frankly, it's too complicated for us to analyze. So good luck with that. It's like, okay, but what are you talking about? I'm inventing a new model. I'm scaling a difficult part of the market. I'm attracting private sector, and you're telling me it's too difficult to analyze. And that's a pity. We've also been told, for example, and I'm just trying to be very specific, that it's easier. I mean, I'm putting words in mouths here. Maybe I shouldn't, but it's easier to dump another $50-100 million on a partner and a manager that we've worked with for the past 10 years than go into a new relation with and onboard a new partner or a new manager and spend time to get to know him and get to know his new ideas. And so in terms of efficiency as a manager, and I'm not criticizing, I'm just flagging that this is something that could change, hopefully.
No, these are criticisms and they're spot on. They're spot on.
Okay. Well, it's because I'm living them every day, you see, and then we come to them and say, well, instead of dumping another $50 million on something that manages already $2 billion, why don't you look at something very innovative and very new that could actually break bottlenecks and be scaled up later? As you said, we are creating new markets or new ways of addressing gaps in the markets that nobody goes to, Andrew, and it's very tough. And then last but not least, certainly not least, it's the fact, and I understand where it's coming from, and again, it's not a criticism, but the fact that most DFIs have a very siloed approach, right? I'm interested in gender in Africa. Don't talk to me about gender in Latin America. And then, no, I'm interested in energy, but you know what? Not in Latin America. I prefer Asia. And then you start talking to 3 or 4 DFIs, and suddenly your investment strategy becomes just impossible. Because if you try to satisfy the criteria of all those, DFIs, it's just impossible. And the problem is that we cannot raise money on a fund-by-fund basis. But our problem, again, working in the missing middle with the small ticket sizes in difficult countries, if you really want to attract private sector, you need to scale, right? And in order to scale, a fund that invests an average loan size or an average ticket size of $1 million, you need to aggregate those funds, because on a per fund basis, I will never get to a $500 million or $1 billion fund managing average ticket sizes of 1 million. That's not possible. I cannot manage that. But it's the condition for me to attract serious private sector institutional money to those, to those funds, to this missing middle. So how do I do that? Well, I solve for scale by aggregation. But if by aggregation, I'm facing DFIs telling me, I like this, but I don't like that, and I like that, but I don't like this, there's no way I can have the catalytic capital to get me to scale. See what I'm saying? And so that's another problem. So sorry, Sam, but if in my day-to-day life I have to flag 3 things, it's be more risk averse, embrace innovation, and don't think siloed. That's it.
Thank you, Jean-Philippe. I mean, I think it's important to hear perspectives from those trying to do this. So really value your things, and I think you've stimulated some responses from your fellow panelists. But maybe just because there's time's tight, maybe what I'll do is I'll go to Joyce to because I've got a question for you, and then maybe we can just bounce off of each other a little bit on some of those remarks, and then we will open the floor for Q&A with the audience. So Joyce, what do you think can drive DFI investment to better support this kind of transformative change that we talk about?
Yeah, and then again, from my perspective, what we do is capital markets development, which actually, Andy, as you say, you can talk about it in the international markets or in the specific local markets within a number of these countries. And we do both. My message would be very much in the same line as what Jean-Philippe just said. Size is extremely important, and when you want to innovate and create something that doesn't exist yet, in our experience, how we deal with the DFIs is that you don't actually bring them in the first step. You have to wait until you are more established. And then the problem with that is that who else is there that can help you with the first step? It is the donor organizations and the agencies, which are fine for risk. They're very patient for yield, but they don't have the depth of knowledge that the DFIs have. So what we end up being is we end up having to partner with very willing partners, donor organizations who trust us to do the right thing, but who are not the most optimal partner because they don't know themselves whether what you're doing makes sense. If you want to develop the Nigerian capital markets or work in SME finance in Kenya, right? So there's a little bit of a mismatch in timing. We have to wait until the second or third year to bring in the DFIs because they don't have the risk appetite to come in at the first stage, and therefore the partnerships are not as deep as they could be. For me, one of the things that I find in my discussions with DFIs, talking about market development and mobilization, is that the KPIs that are associated with mobilizing money from all other people, whether this is local capital market development or bringing in the private sector more generally, those KPIs are not the primary KPIs that these institutions are driving for. They're driving for jobs, for CO2 emission reductions, they're driving for gender, but market development either doesn't exist there as a KPI of interest, or it's not the primary focus, or thirdly, it's actually pretty hard to do. And not very many people are involved in trying to think about what is a good market development and KPI. I mean, people understand how you mobilize money. So if I bring a private commercial bank in, I can measure that. But the quality of your work is hard to catch.
Thank you. So just, I say the panel have I think, Jean-Philippe, your remarks have stimulated some reactions from the panel. So Andrew, I think you wanted to kind of intervene or reflect on some of the comments that you've heard.
Yeah, sure. So Jean-Philippe, if you ever feel like anyone at the DFI, particularly DFC, is telling you that something, you can't do it because it's too difficult, that's when you pick up the phone and you call me, because that's my job, is to make sure that we do the difficult things that make sense. But a couple of things that I want to point out. I'm going to tell you all two stories, right? When I was Power Africa coordinator, I would go and I would brag to people in our Congress about how Power Africa as a partnership helped 120 power projects worth over $20 billion reach financial close. And it only cost us $500 million in appropriated dollars to achieve that $20 billion. And everybody in the Congress loved that and said, wow, you know, you got a 40 to 1 leverage for the amount of money that we gave you to do this project, I mean, to do this program. Now I'm going to tell you the same story. Well, let's pretend that as a DFI, I said, we've invested in 120 power projects that are worth $20 billion, but we have lost $500 million doing that. It's the exact same story. The money comes from the same place. It comes from the same US Congress. But the cultural and the psychological difference of having lost $500 million on a portfolio basis, it's suddenly an outrage. And we got to get people to get past that, because that's what the role of a public institution is. We are not a commercial bank. And if we can lose $500 million, but get $20 billion out there for 120 projects, we're being tremendously successful. We're helping shape future markets. And so long as we step away. The other point that I made about like how I don't really care how much money we actually move. My perfect world would be that DFC doesn't disperse a single dollar. In fact, what I think we should be doing is getting projects all ready and pretend that we're going to be doing it because nobody's interested. But at the very last minute, say to a commercial bank, okay, we've done all this work. Now, do you want to take this over from us? Because that's the role of a public institution. And we don't put as much money at risk. So we have to stop thinking that we are commercial bankers. We have to think like commercial bankers, but we're not. We're a public institution that's designed for delivering development or foreign policy results. And I think all the DFIs and MFIs have to remind themselves of that.
Yeah, but Andy, you know that most of your colleagues don't say it.
I know.
That way, right?
And that's what I'm saying. This is a psychological and a cultural issue. And I can say that having come from USAID. I was the lawyer who helped design our loan guarantee program, which is now at DFC. And it was shocking to me during the height of COVID, when suddenly the team that came over from USAID brought a deal forward to do lending to farmers. And I thought it was a spectacular program. We were going to have to use $5 million of appropriated dollars in order to lend 35 million. And I said, wow, we should make it 10 times the size. But from the people at OPIC, the idea of taking $5 million to help offset the risk, it was an outrage. Like, there's way too much risk associated with this project. But from the AID side, they're thinking, like, instead of spending $35 million in grants, we're only using $5 million in order to release $35 million in lending, and there's a good chance that we're going to get paid back on most of that. So it's this huge psychological and cultural disconnect between development institutions, the donor development institutions, and the development finance institutions. And my job is to try to reduce that and get them to work meeting more in the middle.
Thank you, Andrew. And just before we come to Q&A, I mean, Catherine, you wanted to pick up on a couple of points on leverage and pension funds that colleagues have raised.
Well, perhaps actually immediately on that leverage point, I think there are, Andy, to follow your example, two stories to come in on. One would be quite recently corporate telecoms bond issuance, actually getting the likes of the Emerging Africa Infrastructure Fund and DEG to come in as anchor investors on something like that, end up with the best possible outcome where actually their potential input was scaled down because of actually better demand than they perhaps anticipated. That to me is a win-win, because they've come in, they've helped anchor that issuance. It provides comfort to others on both the legal structures, the due diligence, as well as frankly that initial investor interest. They don't actually have to put forward the amount of money that was initially anticipated. I think that kind of impact can be hugely powerful, and in that way you're also helping create and support the capital markets, which gives them, to the points made earlier, an out at the point that seems sensible. I think those are important. And I think the other bit we haven't really addressed, but we've talked a bit about the role of commercial banks. And Jean-Philippe, you talked about how you are viewed and the amount of support that can be deployed to smaller, newer organizations. I think actually both the DFIs and the donors can play a really important role thinking about how they fund new vehicles, be it through guarantees, be it through official recourse, be it through funding. Because if I'm totally honest, from a commercial bank perspective, when we're rating partner organizations, looking at our exposure to them, the recourse to a sovereign, the guarantee structures that are in place, not to the on-lenders, but to the actual entities themselves, matter a huge amount. And even for a donor or DFI, having flexibility and thinking that the impact they have through the way they structure and fund other vehicles can be hugely impactful. I'm not sure we've quite captured how that impact is measured and taken into account as part of the DFI's work well enough for that to be scaled up, because that can have a huge impact.
Thank you, colleagues. So I'm going to open up the floor for Q&A. We've had some really interesting questions come through. So I'm going to, we've had a question come in about this issue around, we haven't actually spoken around DFIs doing more technical assistance to build markets and transactions. So should DFIs be doing that, or is that for the development agencies? I'm not sure anyone who would like to take that question. Maybe Andrew, what's the position of Usdfc?
So we actually have now the ability to do technical assistance. That was another one of the changes that was when DFC was created. So we have a technical assistance window. It's generally linked to projects in which we are investing or planning to invest. So it's not, we can't just do a market study. I mean, we can in some cases, but the idea is it should be linked to a project. But we work very, very closely with USAID and other agencies to make sure that projects are getting the technical assistance that they need. For example, a wind project that DFC is financing in Kenya that needed a study done because there was an issue with the migratory bird species. USAID stepped in and did that study.
Thank you. And maybe just to pick up a bit more on that point, I mean, one of the things we found in in our research, and I guess at the risk of generalization is a kind of an investment approach by DFIs, which is, if you like, deal driven, if you like, opportunistic, rather than a more strategic view of investment to create, sectors, and technical assistance and grant finance is really important there. How do you see, how can DFIs change this?
So that's been the main cultural shift that I've been pushing at DFC, is to stop being a reactive organization and just talking to your client and saying, hey, what deals do you have? And we're going to do this. And then measuring your impact on a deal by deal basis, but rather saying, all right, strategically, we want to have this impact across this sector. So our roadmap for impact identifies 6 sectors: healthcare, energy, food security, water and sanitation, financial inclusion, and infrastructure and communications. We want to see on a portfolio-wide basis, can we have an impact, which means reaching out and diversifying our client base. About 80% of OPIC's business came from the same 20 clients. That's ridiculous. So this is a big change. So what we've been doing at DFC is we've actually been organizing virtual town halls with local companies all over Africa to make sure they're aware of our tools, because it's important for us to diversify our client base, but also identify opportunities on a sector-wide basis to see if we can really use our portfolio to move the needle on a sector-wide basis for development. But it's not without controversy. I mean, there are a lot of people within DFC who still believe, and it's a legitimate point of view, that we have to follow the private capital and do it to clients, that we can't create markets. I think there's somewhere in between, and we've seen this with IFC, where they just hired 300 people for the purpose of doing upstream project development, for the very purpose of trying to have impact on a sector-wide basis or in certain markets.
Okay, of course, and not all DFIs have that capacity or resource. So I guess there's an issue around kind of collaboration and coordination there. Now, Jean-Philippe, another question that's come in directed for you is, can you please tell us why you see DFIs as risk averse, and are they negating their catalytic roles?
Oh, that's very simple. I'm looking for $50 million for the first losses of 4 blended finance funds, and I'm not finding it. And none of the DFIs said yes to invest in the first loss catalytic tranche of blended finance vehicles. That's the basic simple answer. And again, I'm talking from a very biased angle, which is my experience in the trenches, working small scale in difficult markets and with small SMEs and small companies at their early stage of their development. But I'm not finding this capital to de-risk private sector that should be channeled to that sector. That's precisely why I'm saying that they are risk averse.
Let me add to that, Sam. An example of a discussion I had 2 days ago with a DFI on a new concept that we're trying to launch in Africa. And the first question the DFI person asks is, well, who's providing the first loss? And at least 50%, please. And if the answer is, well, some of you guys, then, well, no.
And Sam, if I may just continue just very briefly, it happened to us sometimes that we were successful in getting government money directly, right? Public sector money in the first loss. And then their question, which I think is legitimate, is why would we guarantee DFIs coming in the senior tranche or lending money to our fund when actually we're de-risking private sector? You see, so then we are in a difficult position, because not only have we found this time, some public money to de-risk private sector, but then talking to DFI saying, now that we are protected, we're willing to come protected by some governments in Europe. That's a very difficult conversation, you see, and that's again why I'm saying that hopefully, there's additional windows of risk-taking opportunities that are created within DFIs.
Thank you. There's a question on impact, a couple of questions which have come in on impact. So maybe I'll direct these to Joyce and Andrew and others as well. So, I mean, Joyce, you mentioned, I think, a really important issue around kind of KPIs, and really no KPIs around what market development kind of looks like. And I guess if you don't if you don't measure it, it doesn't get done, that adage. So it's kind of, there's a question which come in is what do you consider as impact, and how do you measure it? So maybe reflect on that. And Andrew, there was a question that came in around impact and volume, saying you're insisting on impact rather than volumes, and the World Bank has been claiming this for years. But this doesn't work in a model where a DFI must be financially self-sustainable. The risk profitability volume equation is the same for all DFIs. I think you might have touched on that, but maybe if I can, what do we mean by impact?
So two things. First, the point about, well, this is what DFIs have been doing for years. Well, what I'm saying is people really need to rethink the DFI model, because it's not being successful. People have gotten very comfortable, and you really need to shake this up and think about it differently. But in terms of impact, what DFC is doing, we have developed this really state-of-the-art tool for measuring impact. It's called the Impact Quotient, the IQ, and it was developed in consultation with development stakeholders and other DFIs and IFIs, and we analyze each project based on its anticipated development impact, looking at innovation, economic growth, and inclusion as well, and then subsectors. And we really use economists looking at the impact of every deal, and they're given a score, and then we measure that. We measure that sort of throughout the time of the transaction as well. So we're going to have to step up our M&E. But we also are looking at, this is the idea behind our development strategy, is looking at a sector-wide basis. It's one thing for an individual project to have impact, but are we making sure that as on a portfolio-wide basis, we're having an impact? So this is why it was so important when we launched our development strategy. It wasn't just about investing $10 billion in energy, but it was making sure that at least 10 million people get access to electricity. It wasn't just about investing in ICT, but making sure that people are actually getting access to the internet. So we're requiring all of our deal officers, as they bring forward a transaction, to talk about how the particular transaction is going to advance the metrics that we've identified.
Joyce, do you have any reflections on impact?
Yeah, so obviously it's very easy to measure mobilized money. So that's not particularly the issue, but it's more the quality of the mobilization that needs to be taken care of. And so the way we've done it, for instance, for Garantco within the PIDGE, is that we score certain qualitative elements of the transaction and add to that. But that requires quite a good understanding of what that means. So within the institution that works, but it's very specific to the institution. And there's not yet much. I'll give you an example of the ultimate impact, also what Andy was saying. In Nigeria, we were participating in the creation of InfraCredit Nigeria, which is guaranteeing deals for pension funds locally. And the institution started work in 2018. Last year, the first infrastructure deals were placed in the market without any guarantee. So the absence of InfraCredit was its most strong impact. And so how do you weave that into the impact, the KPIs, other than a good story, is very hard to do, in particular because the causality is not easy to prove. If you're not daily into the market, if you don't know what's going on between all the players, it's hard to be certain that the fact that InfraCredit did 2 or 3 transactions 3 years ago, and then another bunch of deals the year after, led to the pension funds being happy to invest without guarantee a few years later. So okay. It's a complex field to navigate, is my opinion.
Okay, thank you. And one last question, Catherine, maybe just 1 minute. A question that's come in for you is that you've mentioned an expansive mandate which rests with public institution, vast roles, expansive governance, and a lack of it, and a lack of a similar mandate in private institutions. What is the need for innovation in the mandate for private institutions? Can you say just briefly a little bit more than that? And then I'm afraid we're out of time, and I'll quickly wrap up.
I mean, look, every private institution has a different goal. If they're publicly owned, there's a return for shareholder, there's responsibility to their employees, responsibility to the communities and the environments in which they operate, and different entities will have different priorities within that. I think the point really to make is about how do we align the goals, and to come back to that point of impact, the measurement of impact, so that if we are looking at how DFIs transition over time out of a role, and to Drew's point, actually, do you end up with them not being involved as your ultimate outcome? You're helping set up the structural situation such that there's more of a seamless transition from a DFI needing to be involved to frankly not being involved. I don't think that's going to necessarily change people's complete mandate. It's more about the objectives they are trying to achieve, and how do we kind of bring them from here, meet somewhere in the middle.
Okay, well, I'm afraid we have run out of time. We have had some questions I'm afraid I haven't been able to bring to the panel, so my apologies. I just wanted to thank everyone. I mean, it's been super interesting to listen to this conversation. I think three things for me have stuck out from this. One is this, this kind of mindset about what DFIs are there to do. And then with that, this issue around business models. And I've heard very clearly, issues around high risk capital, that early stage kind of investment. And of course, the business model change and mindset that needs to change to enable that to happen, but also the objectives and then the kind of KPIs and incentives which will drive also change in behaviour. So it seems that there's some kind of, there's some structural issues which we need to quite urgently address. I found the conversation really, really refreshing. Thank you all for your time. I hope the audience have enjoyed the conversation, and the report, I believe, will now be live on our website. So thanks once again, everybody. Take care of yourselves, and join us soon at ODI for another conversation. Bye.